just remember that it's not just one simple answer that can cover everything. Just because a home is capital gains tax free doesn't always mean it's a better option. Very simply, capital gains tax is the tax that you have to pay when you sell an investment property. We all know that if we have a principal place of residence, which is the home that we live in, that home is not subject to capital gains tax. So automatically, the assumption is, well, buying a home is better because you're not paying capital gains tax. The real answer and the reality of the situation is a lot more nuanced than that. First of all, when you're buying an investment property, if you're holding on to that property for a period of more than 12 months, you do get a 50% capital gains tax discount, right? So immediately on an investment property, assuming you're going to hold on to it for more than 12 months, there's a 50% discount. And that's on as many investment properties as you want, not just on one. Whereas on the other hand, if you're buying a home to live in, yes, you do get your capital gains tax exempt, but that's just on one property at a time. So when you're comparing it in that scenario, then the answer becomes a little bit more complicated, because think about it, what would be better? Having one property and only one property being completely capital gains tax exempt, or if you had a property portfolio of say 3 or 4 properties, but each and every single one of them had a 50% discount. In that scenario, then I don't think it would be a very fair comparison. On top of that, you also get other benefits like deductions, tax deductions, and negative gearing benefits on your investment portfolio as well that you won't get on a principal place of residences as well. So when it comes to capital gains tax, just remember that it's not just one simple answer that can cover everything. Just because a home is capital gains tax free doesn't always mean it's a better option, right? You really have to look into the details of the situation. Now, the way capital gains tax is calculated as well can also be something to consider as well, because capital gains tax, really what that is income tax. So it depends on your income tax bracket will determine the amount of capital gains tax you pay on the profit of a sale of a property. And you understand? So let's run an example here. Let's say you're buying a property for $500,000 and then you sell it a few years later for $700,000, right? So your capital gain is $200,000. Now, if you get a capital gains tax discount, which is 50%, then you're only going to pay capital gain on $100,000. 50% of $200,000 is $100,000. Then from that point onwards, you also have to deduct all of the deductions as well, the expenses relating to the sale of the property. So for example, all the fees, the lawyer costs, the agent's commissions can be all deducted as well. And then whatever's left over, that gets added to your income. So if you were earning, say, $50,000 for that financial year, you have to add that profit, whatever our net profit is, to the income, and it's going to actually push your income bracket up, right? So if you were, say, on a 35% bracket before, you might get pushed up to like a 42% bracket or something like that. And that's where capital gains tax really can affect things, because it's based on income tax. So what I recommend to a lot of people is you really have to plan out when you sell your property. You want to plan out the sale of your property assets in certain years where you're not earning an income or earning very little income. So for example, if you're having a gap year, if you're having a year where you're on maternity leave and you're earning very little income, or if you are retired and you're not working anymore, right? And you're on a pension now, selling your property in those years are always the best option, because that way you will pay least amount of income tax in those years.